I am Damian Pudner, Director of the IIMR, and today we are very fortunate to be hosting Lars Christensen. Lars is a renowned Danish economist with expertise in international economy, emerging markets, monetary policy, and sports economics. With over 25 years of experience in government and banking, he is the founder of Markets and Money Advisory and is an associate professor at the Copenhagen Business School. Apart from his work in finance, Lars is passionate about sports economics and analytics. He previously served as an economic policy analyst at the Danish Ministry of Economic Affairs and holds a master's degree in economics from the University of Copenhagen. Lars gained recognition as the former head of emerging markets research at Danske Bank, where he authored influential economic reports on Central and Eastern Europe. He accurately predicted the Icelandic economic crisis in his report Giza Crisis in 2006. Lars is the author of Milton Friedman, a Pragmatic Revolutionary, and is known internationally for his expertise in Milton Friedman's economic teachings and the history of monetary thought. He is credited with coining the term market monetarism, advocating for central banks to target nominal GDP levels. He occasionally blogs on marketmonetarist.com, founded in 2011, and serves on various boards and advisory boards. Today, we will be discussing where is inflation going, after which we hope to allow time for a Q&A with viewers online. As always, today's presentation will be recorded and made available on our YouTube channel. Please see our website, www.mv-pt.org, to access this and other webinars in our series. A reminder that questions must be submitted via the Q&A option, which I will moderate and address directly to Lars. And with that, I'll hand over to you, Lars.
Thank you, Damian. A pleasure being back, talking about one of my favorite topics, money. Because what we're going to talk about is where is inflation going? I think this should illustrate what I essentially think of inflation. This is, of course, Milton Friedman, or AI-generated version of Milton Friedman. And Milton Friedman used to say inflation is always and everywhere monetary phenomenon. And obviously, the fact that I strongly believe that we can only have inflation if more money is printed than is demanded. It's obviously given the demand increase in the money supply we have seen over the past 3 years that eventually we are going to have inflation. And therefore the question is, will we continue to see inflation going forward? And I will talk about a framework to understand that. And then I might go to the somewhat paradoxical conclusion that maybe our concern in terms of inflation really isn't money, but something else, but we will return to that. So the overall agenda is that, first of all, I will take a look at what we will call Milton Friedman's framework, or the general framework that we can understand in the so-called equation of exchange. I think a lot of the viewers and listeners here on this webinar are familiar with that, but I think a reminder nonetheless is important. Secondly, I will try to talk about the importance of monetary policy rules and what it means in terms of understanding of the world when central banks follow rules and when they don't follow rules, or whether we could say when monetary policy is politicized, when money is politicized, what happens then in terms of the understanding of inflation and in terms of money. So let's start with the equation of exchange. Obviously, first suggested by the American economist Irving Fisher, essentially says that on the left-hand side of the equation, we have M times V, which means money times the velocity of money. Velocity of money is, of course, how many times or how often the amount of money is circulated in the economy in a given time frame. On the right-hand side of the equation, we have the price level P times Y, which is the amount of transactions in the economy, the production, or sometimes we just say that this is a real GDP. So P times Y also means nominal GDP. Obviously, what we show here is that we can reorganize that, and then we can see that M times V, meaning the circulation of money in the economy divided by the size of the economy, Y, determines the price level. Or said in another way, as Milton Friedman says, inflation is always and everywhere a monetary phenomenon, in the sense that it is and can only be produced only by a more rapid increase in the quantity of money than in output, and I have added in velocity. A way of thinking about this is that money is the good in which we all barter. We always use money to barter everything else. But imagine a world without money. When we read the newspapers, watching business programs on TV, etc., we are told that inflation is caused by a war in Ukraine, oil prices, gas prices, labor union, taxes, whatever. However, you've got to ask yourself, if that's the case, could inflation exist in a world without money? And I think really, if I want to be critical about my fellow monetarist and about Milton Friedman, is that we often fail to look at the world without money. We try to get people to understand why money creates inflation. But maybe we should say that money creates inflation can logically follows from the fact that in a world without money, inflation cannot exist. Because in a world without money, we have in a pure barter economy. We have two goods in the economy. We have beers and coconuts, and we can trade beers for coconuts. And there is a relative price of how many coconuts you need to buy a beer. And the supply of coconuts and the supply of beer can be disrupted by different things. And changes in preferences can change the demand for coconuts and the demand for beer. But if the price of a coconut goes up, price of beer will go down by a similar ratio, because the price of a beer is measured in how many coconuts it costs, and the price of a coconut is measured in how many beers it costs. And therefore, if we were going to construct a price level or price index, then that index would always be equal to the same number. The price of one good will go up, then the other would have to go down by a similar amount. So the only way we can make the price both of beer and of coconuts to go up is to introduce a third good, that third good being money. And if we now agree that you can only buy coconuts and beers, not for coconuts and beer, but for money, you always use money, then if we increase the supply of money, then it will follow logically from the supply and demand of things that the price of money will have to go down relative to coconuts and beer, meaning the purchasing power goes down, and that's inflation. So it follows logically that inflation can only be a monetary phenomenon. Inflation can only exist if money exists. Obviously, in the caricature of the equation of exchange, you'll often read that monetarists tell us that there's a one-to-one relationship between the amount of money in circulation and the price level. Monetarists are not saying that. Monetarists are saying that there has to be a relationship, that if you print more money than is demanded, the purchasing power of money will go down, and therefore the price of goods will go up. But no monetarist, not any of the recognized monetarists, have ever said that there is a one-to-one relationship. It turns out that historically there has been essentially a one-to-one relationship between the growth of broad money and the price level, historically. But it has never been a month-to-month, week-to-week, day-to-day, or year-to-year, quarter-to-quarter, or even decade-to-decade relationship. But over time, it's pretty clear that there is such a relationship. But let's look at something that is related to this, the velocity of money. Going back to the 1970s, the debate within Keynesians, the kind of Keynesians who essentially do not exist anymore, and monetarists, was that whether velocity of money were more or less stable. No monetarist ever argued that it was completely stable, that velocity never changed. But monetarists have argued that that velocity moves in a fairly predictable way and is relatively stable compared to other things. And but obviously velocity can change over time. Our preferences to hold cash or money changes over time. Younger people holds another amount of cash and money than older people. If you have more risk appetite, you don't care to hold money. You might buy stocks or properties or whatever. But if you're very risk averse, one might want to hold money rather than equities or bonds or properties. So demographics can change velocity. Financial regulation can change velocity. In the aftermath of the 2008 crisis, governments around the world tightened financial regulation very significantly and essentially told financial institutions to hold more cash and to hold more safe assets, and thereby essentially creating an increase in the demand for money. For a given money supply, an increase in the demand for money as a result of financial regulation will cause a deflationary shock. But some of that we can take into account by the way we measure money, because money is, of course, not necessarily easy to measure. Because what is money? Is money just cash, or is it cash and the money you have in a bank account? And economists normally define it as cash and deposits in a bank account. But what about time deposits? But how about certain money market papers? Is that money? It's near money. So a way of adjusting money supply numbers is so-called division money. And I think that division money in many ways is preferable to the normal way of we measure money supply. I'm not religious on this, but I think it's useful to look at both normal money supply numbers and division money supply numbers. So what I've done here is I've calculated the velocity of division M3 velocity in the US since 1987. The reason I started in 1987 is not completely random. It's the year that Alan Greenspan became Federal Reserve Chairman. And that, to me, is the beginning of the Federal Reserve effectively starting to have inflation targeting in some shape or form. Obviously not to begin with officially, but it became well understood by market participants and by general participants in the US economy and the global economy that the Fed was targeting some kind of measure of price stability, low inflation, and so forth. So that's in broad terms the same regime as we have today and has ever since. We have had changes, and the Fed have been more or less successful in communicating that. But in broad terms, that's the beginning of to me the beginning of the inflation targeting regime. And you can see that in economic terms, or rather in statistical terms, we can see that the velocity of deviation 3 is what we'll call stationary. We revert towards some kind of mean over time. And you can see something interesting if you go and look at the graph. What happens in 2020 during what I would term the lockdown shock. We had this very significant drop in money velocity. That might be to some extent a definition question or a measurement error, because did we start to demand more money, or did we just stop using money? Because essentially there was rationing of a number of sectors where we were not allowed to travel, we were not allowed to go to sporting events, we were not allowed to do a lot of things. And therefore, we essentially, by default, hoarded money. So we increased the demand for money. Obviously, there was also fears and so forth that led people to increase the demand for money, hold safe assets. You can also see that since then, since the ending of lockdowns in the US and globally, we have had a return of the velocity more or less to the starting point in 2020. We've been returning that. We're not all quite there yet, but we are returning to that. And I think this is important in terms of understanding why the slowdown in money supply growth, and I'll get to that, has not sparked a recession and might not necessarily spark a recession going forward, neither in the US or in Europe and the UK. Because the picture in the UK and Europe is similar. It's not the same, but it's similar. So a lot of what I'm saying will apply to the UK and to a certain extent also to the Euro area and to other European non-Euro countries. So you know, the caricature of monetarism is that, well, monetarist says that the velocity is stable, hence the growth rate of the velocity is 0. So even though I don't believe that's the case, and I think that if we needed to formally model inflation and predict inflation, we need to take into account what happened not only to the supply of money, but also to the demand of money, hence to velocity. I nonetheless here assume, for simplicity of the analysis, that the change in velocity month to month, year to year, quarter to quarter, decade to decade is 0. And that then if we then say we want to target a given inflation target, then we can rewrite the equation of change. And here you can see that we have M plus V equals P plus Y, and you can see it's no longer capitals. It means that we are talking about growth rates of the money supply plus the growth rate of velocity equals the growth rate of the price level, meaning inflation, plus the growth rate of the economy. And then I go back to what sometimes is called the Friedman rule. There are a number of rules called the Friedman rule, but this is sometimes what is also called the K rule. That Milton Friedman argued, at least for a period of his academic career, that to ensure price stability, the Federal Reserve and other central banks should target the money supply. They should grow the money supply in a way that was consistent with stable inflation, low and stable inflation. And so what give us the money supply, or our target for the money supply, is our inflation target. Let's say that inflation target is 2%, plus the trend growth of the economy, real trend growth over this business cycle. In the US, that's probably somewhere between 2% and 3% over 2000 let's say the Great Moderation period, starting in the mid-80s and going until now, minus the velocity of money. But as I said before, let's assume that's zero. So you would see that if we have 2% inflation target plus trend growth of 2 to 3%, that would give us a money supply target somewhere between 4 and 5%. So this is what I have here. What I've done here is the blue line is the actual growth rate of divisor M3 year on year. That's the blue line. The orange line is the implied target. I have taken the inflation target to be 2%, no, 2.5% prior to 2008, and after that 2%. Because prior to 2008, the Fed didn't formulate the inflation target, but it was generally perceived that the Fed was targeting 2.5% inflation rather than 2%. But after that, the Fed now officially targets 2% inflation. And furthermore, I have taken the trend growth in real GDP from the Congressional Budget Office that makes quarterly assessments of what trend growth is in the US, and I just added that to the inflation target. And then I have taken plus minus 1 standard deviation of the actual growth rate of the money supply, and added and deducted that from that K rule, from that Friedman rule. And you can see that over time, the actual growth rate of the money supply has been close to the Friedman rule. Of course, not from day to day or year to year, but if we were plotting this in the growth rate, in the price level or the money supply level, and the actual and the K rule where the level would be, the two lines would be more or less on top of each other. So if money supply growth is too slow one year, it will have been faster the following year, and so forth. And obviously, we also know that this period is a period marked by general price stability. However, you can also see there are two major deviations from the Friedman rule. 2008, 9-10, you can see that there is a very sharp contraction in money supply growth. And here I would have to argue that is only visible in divisor M3 numbers. It is not visible, for example, in the official M2 numbers. The divisor numbers captures that monetary tightening much more clearly than the simple sum money supply numbers. But you can see that monetary policy became way too tight relative to the Friedman rule in 2008, 9, 10, meaning too tight monetary policy. On the other hand, you can say since 2010, 11 until 2020, the actual growth rate on the money supply was very, very close to what would be implied by the Friedman rule. The Fed was essentially monetarist. And you can also see the period, at least from, let's say, 96 until 1997 to 2007, 2008, the Fed was also essentially monetarist. But then you can also see that if we look at the graph, the 2020 was a significant deviation from that. Very significant deviation from that, with very, very strong growth in the money supply. And obviously, one could argue that that was necessary because we also saw a sharp increase in the demand for money. Velocity plummeted. And back in 2020, I argued strongly that given other policies implemented, not policy that I necessarily supported, I did not support lockdowns, neither in the UK or in my own country of Denmark or the US. I thought they were draconian and very, very wrong policies. But given those policies, and and that triggered a sharp increase in demand for money. The right policy was to accommodate that very sharp increase in demand for money by printing more money. However, if we go back to the velocity graph, we can also see that starting in 2021, velocity started to recover. Started actually to recover during the summer of 2020. As the velocity of money recovers, of course, the Fed should have moved to normalize money supply growth. The Fed did not do that. Instead, we all remember and return to that, the Fed in the summer of or in the beginning of 2021, at that point, I was completely convinced. And I even at a IIMR webinar in 2020 said that there was no inflation problem. And I think I was right. I didn't think that the increase in money supply was an inflationary problem because I was completely convinced, and I was completely wrong, that the Fed would start to normalize and reduce the growth rate of the money supply significantly, starting in late 2020 and going into 2021. But that did not happen. Rather, when we got into 2021, Federal Reserve Chief Jerome Powell famously said that inflation was transitory. He essentially said that monetary policy is not the reason we have inflation, and we do not have responsibility in terms of ensuring price stability. That was essentially what he was saying, and he just kept on printing money. And obviously, from that point, velocity continued to recover very rapidly while money supply growth kept on growing. And given the equation of exchange, we were growing at that time, and you can see it. You can see that the blue line here has remained above the orange line all through 2022. So it keeps on increasing. And if you look at that in levels, and that's what you can see on the next graph, you would see that we moved well above that. So what we have here is the blue line on the left is the level of divisor free money. The orange line is a 4.25% trend. Why that number? Well, that is the number. That's the average growth rate of the money supply that would be implied by the Friedman rule during that period. And you can see that the Fed was following that rule from 2012 until 2019. We can even go further back. Was following that rule more or less. But then you can see that very sharp increase that I was talking about. And the sharp increase in 2020, I must stress, I strongly favored, and I do not think the Fed made a general policy by mistake in 2020 by expanding the money supply. Operationally, they made many operationally and communication-wise, they made many mistakes that caused problems later on. But in terms of the pure expansion of the money supply, I fully endorse it. But what you can see that following, let's say, September, October, November of 2020, the blue line keeps on growing and keeps on growing faster than the orange line. And it's only once Jerome Powell is reappointed Federal Reserve Chairman in November 2021 that the Fed start to communicate and actually enact policies to reduce the growth rate of money, that we start to see a decline in the money supply. You can see the blue line peaks in the autumn of 2021, or 2000. Sorry, in the peak in the autumn of 2022, around a year ago. Since then, we have seen a decline in the money supply. But you will also see that we still, in terms of level, in the nominal level, we are still above the orange line. And when somebody has been arguing that we have negative growth in the money supply, in Europe or in the Eurozone, in the US and in the UK, that is recessionary, I would have to highlight the fact that when we look at the level of the money supply, that has been necessary to reduce the monetary overhang, to reduce the excess liquidity floating around in the global economy. And it's only by now we're beginning to close that gap. If you look at the right-hand side of this equation, it's important, of course, to remember that money is not money. The purchasing power of the money I hold in my wallet depends on the price level. So if I deflate the money supply by the price level, that's the blue line on the right-hand side. It's the real deviation money. And then we look at the real trend in the money supply in the period prior to 2020. We can see the gap has now been closed. So US monetary policy certainly somewhere in the second half of 2020 started to become expansionary relative to the demand for money. And the great policy mistakes were made during the period of 2021 when the Fed should have acknowledged that money velocity was recovering very strongly due to the reopening of the global economy or the ending of the lockdowns in the US and everywhere else. And therefore, money supply growth should have been brought down much, much faster. Instead, the Fed kept on its expansionary policies and ended them nearly 2 years too late. The result, of course, being the spike in inflation that we saw. So the question we asked ourselves to begin with, maybe I can go back to that, is where is inflation going? And I'm reminded with this question to a quote by Milton Friedman. In the early 80s, Milton Friedman produced a TV series called Free to Choose, which, of course, as you might know, was turned into a book later. In one of the episodes in Free to Choose TV series, Milton Friedman is visiting the Federal Reserve. In fact, he's standing by the printing press and the money is just coming out of the machines. And it's very, very noisy. And one sees a hand on a button that stops the printing press, and the printing press comes to a halt, and the noise from the printing press disappears. And Milton Friedman asked the question, what happens to that noise? Inflation would go the same way. And my answer to the question, where is inflation going, is that we can see from the graph here on the left and on the right that somebody pushed that button, stop the printing press, around a year ago. Oh, sorry, 2 years ago. And of course, starting with what Friedman would say was long and variable lags, and those lags were actually not very long, it was less than half a year, inflation started to decline. And it has kept on coming down since then. So to me, this inflationary episode is now over. Or at least if I look at the next 1 to 2 years, judging from what is happening to the actual money supply growth in the US, in the Eurozone, and in the UK, this inflationary episode is over. And we can see from inflation numbers published today from the US, we are now heading down to 3%. If you look at real-time indicators of US inflation, and I strongly suggest all of you Google Trueflation, which is one of my favorite websites, trueflation.com, where internet prices is scraped from the internet in all kinds of sectors, from supermarkets and other retailers, and a real-time number for US inflation is created. And if we look at that, inflation is down to presently around 2.5%. And I think that's essentially where we are. And I'm not sure we are all heading to 2% in the very near future, but safe to say that inflation is down near or close to the 2% target, and we will eventually get there within the next 2 years. So essentially, we could say the Fed made a terrible mistake, particularly in 2021. The ECB made the same mistake. The Bank of England made the same mistake. A number of central banks around made the same mistakes. Most central banks in the developed world made those mistakes during those years. Only exception really being the Swiss Central Bank, or the Swiss National Bank, the SNB, that did not expand the money supply to near the same extent as everybody else, and kept a very clear signal and clear communication that it wanted to ensure price stability and nominal stability. But the mistakes have now been undone. And essentially, we are now in a place where if central banks start to behave, we should be happy, go lucky, and go back to a 2%. You know, the best forecast for the next 10 years would then be 2% inflation in the US, in the UK, in the euro area. And if we look at market expectations, bond market expectations, that is broadly the expectation. The UK is not all there, but at least for the US and the Eurozone, that is broadly the expectation. So markets seem to be convinced that, yes, they made a mistake, but they're not going to do it again in the next decade. And that might, in fact, also be my main scenario, is that, okay, they messed up really, really badly, but they messed up really, really badly under circumstances that often would lead central bankers to mess up. In many ways, you remember the rhetoric of politicians and policymakers during 2020, and as the COVID pandemic was spreading, we had this warlike feeling everywhere. And with a war going on, at least in the heads of policymakers, suddenly we get an expectation that the central bankers should start to behave as they did during the Second World War, finance the war effort by printing money. And that, of course, is what they did. So the question is, are we now in 1946, or are we soon to return to warlike excuses for printing money again? But before coming to that, I want to make a slight detour to talk a little bit about why money has disappeared from public debate and from economic debate, but also why it has reemerged, and why monetarists, as myself, should not be too eager to only talk about money supply numbers. But why is that? Well, think of when central banks actually follow rules. And obviously, central banks during the so-called Great Moderation period from the mid-80s and until 2008, were broadly following some kind of monetary policy rule that often has been described as the Taylor rule, where central banks would set interest rates, and one can debate whether governments can set interest rates. They can set the money supply to try to influence market interest rates. But nonetheless, broadly speaking, central banks were thinking of themselves as setting interest rates. They were in a monetary policy regime with my good friend Robert Hetzel, of course, Federal Reserve veteran, Bob spent more than 40 years as an economic advisor at the Richmond Federal Reserve. Bob calls this period a policy of lean against the wind with credibility. Central banks was leaning against the wind. Economic activity was high and inflationary pressures were increasing and so forth. The monetary policy was be tightened, and that would be communicated to markets. And when it was going the other way, they would do the opposite and markets fully understood this, and by markets understanding this, essentially market was implementing policies. So that was the kind of monetary policy regime that I graduated from the University of Copenhagen in 1995, and in that period we all talked about rules versus discretion. The central bank should follow rules, and inflation was a monetary phenomenon. We had won, so to speak. In many ways, it was boring to be monetarist in the late 90s, early 2000s, because central banks were essentially doing what we said they ought to do. Obviously, we could find certain problems in the conduct, but they move pretty much in the way that Milton Friedman has said. Central banks have the responsibility to ensure nominal stability, how we define that, and they should follow well-defined, clearly understood, transparent rules. And government should not interfere with what central banks are doing, and they should not create an expectation that public debt would be monetarized, and therefore they should ensure that to balance their budgets over the business cycle, and generally to reduce public debt and so forth. That was the policies of the Washington Consensus, or the policies of the late 90s and early 2000s in Europe, in the UK, in the US. So that was the regime we were working in. But how can we describe that regime within the way we are thinking about the equation of exchange, and why did the equation of exchange suddenly disappear? Why did we have the paradox that once monetarists had won the argument during the 80s? Why then disappear? Why did money supply numbers disappear as a relevant or interesting number to look at? And why did it re-emerge after 2020? Well, I would suggest the following. If we think of there is a demand for money, and here you can see that equation 1 is essentially the equation of exchange, but I write that A times R being the interest rate, change in the interest rates, that determines the velocity of money. So the velocity of money, the demand for money, is dependent on what interest rates are. Often it's said that monetarists do not believe in that. Again, that's wrong. Obviously, the demand for money is dependent on the return on other financial assets, including bonds, money market papers, and so forth. But there is also here what we can say there's a monetary policy rule. Obviously, nobody ever stipulated this monetary policy rule that I write here. But what is it saying? That's the lean against the wind with credibility. It said that the central banks determines the growth rate of the money supply in a way. So it says 2 plus the trend growth of the economy. That's the Friedman rule. Can you see that? So the 2 is the inflation target minus the actual inflation plus the actual growth rate of Y. So what it says here is that the central bank, if it overshoots relative to the Friedman rule, it needs to contract the supply of money, and the opposite. So what if we then take 1 and 2, equation 1 and 2, and put them together? M equal M. Then M disappears from our model. And then we can now isolate, instead of M, then look at R, the interest rate, and saying, okay, we have an implicit, given that money demand and given the money supply growth rule, which is essentially in Friedman rule, what is the implied interest rate rule we have? And, I don't have to go through it here, but it's essentially what we normally term as a Taylor rule, that interest rates are increased when inflation moves above the inflation target, and interest rates are increased when the growth of the economy increases above the trend growth of the economy. So essentially, the Taylor rule is an implicit Friedman rule. John Taylor has often said that, by the way. who came up with the Taylor rule in the mid-90s. So what we have here is that suddenly money has disappeared from the economy. But we can just look at interest rates. But given the central bank follows a monetarist rule, it suddenly looks like they're following a Taylor rule, and money has disappeared. It has been substituted out of our economic model, and that led Marvin Goodfriend, also a veteran from the Richmond Federal Reserve and former colleague of Robert Hetzel, unfortunately now deceased, in 2007, and that was maybe prematurely, or was prematurely, wrote an influential article called "How the World Achieved Monetary Consensus." So what Marvin Goodfriend said was, we have monetary consensus because central banks essentially follow monetarist rules. They don't know it themselves. They think they're following a Taylor rule, but they are adjusting the money supply to hit a given rate for the interest rate that is in accordance with the Taylor rule that ensures price stability. And now we return to where I'm starting. Now money has been taken out of the economy. It's still there, but it's in many ways endogenous. It's not used as a policy instrument that we talk about. And most economic models, they just said, okay, it has been substituted out. We can just look at interest rates. And that gave birth to what has become called the new Keynesian models that became popular. And of course, it's very popular, for example, with the Bank of England or the ECB and the Fed have their own new Keynesian models. And in those models, there's no money. So we are essentially in my beer and coconut economy. Money has been taken out and there can be no inflation. And indeed, there is no inflation in new Keynesian models. Or rather, inflation is always at the inflation target because it's assumed that central banks constantly follow the rules that they stipulate. The problem with that is, of course, you can never in any way analyze when central banks do not follow rules, when they diverge from the rule. As in 2008, when the money supply was allowed to contract far too much. Or in interest rates term, that the interest rates did not decline as much as stipulated by what Knut Wicksell 200 years ago called the, 150 years ago, called the natural interest rate. And again, in 2020 and 2021, when the Federal Reserve and other central bank increased the money supply much faster than stipulated by the Friedman rule, we diverged from those rules. And if you diverge from the rules fundamentally and central banks do not follow rules, the new Keynesian models do not work. The new Keynesian models are great for analyzing when policymakers, both governments and central banks, behave as they should. But that world do not exist. When Marvin Goodfriend wrote his paper in 2007, he thought it existed. He thought that central banks knew what they were doing. And therefore he said that, well, when we're in that world, when they follow rules, we're essentially in a world where the economy moves up and down with shocks to terms of trades, to productivity, what we'll call supply side shocks. And demand side shocks have little importance. Monetary shocks have little importance because monetary shocks was just a residual of the Taylor rule, minor mistakes. But it wasn't really shocks. It wasn't regime uncertainty where market participants did not know what the central bank would do in a given situation. The reason I was wrong going into 2021 was I thought that central banks, even though they made mistakes in 2008, had now learned the lesson, that they would not make the mistake on the too easy side. I was wrong about that. They continue to diverge from that. And once markets and market participants and actors, the general participants in the economy, global economy, understood this, inflation skyrocketed. The new Keynesian models did not capture that because, as I did, the new Keynesian models assumed that central banks followed rules. So that is when money supply numbers became relevant, because what we can see is that in periods where central banks follow well-defined rules, there is, in my view, little informational value coming from the money supply. But in periods where they fail to follow rules, money supply numbers gives a very clear signal about the outlook for nominal GDP growth, for inflation, and so forth. So that's the case. So I have been talking and talking and talking here. So I better end this. But when I said inflation is coming to an end, or we are back to 2% inflation, and that would be my near-term forecast, I base that on the growth of the money supply and also where interest rates are, policy rates are relative to natural interest rates. But I can't help thinking that I was wrong that central bankers were following rules. And they have done little to show me that they will not make the same mistake again. That can be illustrated in many ways. I have some quotes here from Jerome Powell and Christine Lagarde, the ECB chief. Obviously, both non-economist lawyers. Look at the tweet here from Christine Lagarde. We are now observing fossilflation, not greenflation. While decarbonization in the energy sector can cause rising prices in the medium term, we can lower inflation in the long term. That's why green innovation is key. And I was like, that's not in the equation of exchange. Christine Lagarde, by saying this, clearly demonstrates she does not understand that inflation is a monetary phenomenon. Jerome Powell famously also said, we now understand better how little we understand about inflation. Well, we fully well understand where inflation comes from. It is when Jerome Powell prints more money than is demanded. We fully well understand that. And I suspect that Jerome Powell understands this, but he's an excuse to be politicized. So I'll end on a slightly pessimistic note. That I'm fearful that particularly politicians around the world have not learned the lesson from the 70s and the 80s. Central bankers around the world, unfortunately, are not willing to tell politicians about gravity, and that when you print more money than is demanded, you get inflation. So I'm fearful about the politicization of monetary policy. Where I am optimistic, however, is that economists of most kinds, left, right, so-called new Keynesians, monetarists, and others, in general, fully well understand that the policies being pursued by the Federal Reserve, the Bank of England, and the ECB, and other central banks around the world, particularly in 2021, were failed, and was the main cause that inflation increased. So I think unlike the 70s, where the average economist in the UK or in Denmark or in Sweden or in the US did not believe inflation was a monetary phenomenon, I think that most professional economists today understand and has been reminded that Milton Friedman was right, that inflation is always and everywhere a monetary phenomenon.
Lars, thank you again for being with us. I know it's late in Denmark there, so I really enjoyed it, and I'll speak to you soon. Good night.
My pleasure. Have a nice night.
Thank you very much.